Okay. So we now have the part 2 of our lecture, which is on chapter 2 of the course, which is on life insurance. There are 5 sections here. We'll discuss the first section in this part of the lecture for part 2, which is on insurances payable at the moment of death. Okay? So insurance systems were established to reduce the adverse financial impact of some type of random events, usually the loss of life or the loss of an object of some or of great value. Okay? So in other words, the insured buys an insurance policy, and that insurance policy is a contract between the insured and the insurer. And the contract specifies that on the death of the insured, the benefit of the policy is going to be given to the beneficiaries upon the death of the insured. Okay, so the payment of the benefit is contingent on the death of the insured. Okay, so in this chapter, we'll discuss some of the basic types of life insurance. And there are several classifications. One is between when the benefit is paid. It could be paid either at the moment of death and at the end of the year of death. Okay? The first section will discuss insurance policies which are paid at the moment of death. The other classification is whether the benefit size is fixed or if it varies depending on the time of death of the insured. Okay? So we'll discuss first the insurance policies wherein the benefit size is fixed. And then later on, we'll consider the case when it varies. Okay, now the general special types of insurance, the usual one, the simple ones, are as follows. The first one is the whole life insurance. So this is an insurance that will pay the benefit at the time of death of the insured anytime in the future. Okay? So upon the death, regardless of when death will occur to the insured, the benefit of the insurance will be paid to the beneficiaries of the policy. The second type is the Myear Term insurance. Now, the contract here is only for N years. So the benefit will be paid if the insured dies within the N-year period. Okay? After N years has elapsed, after issue, the contract expires. So nothing will be paid upon the death of the insured then. Okay? And then we have the N-year endowment insurance. So this time, the term of the policy is also N years, but it will provide for a payment of the benefit if 1. Death occurs within N years, or 2. A payment of the benefit at the end of N years if the insured survives to that time. Okay? So regardless of what happens, whether the insured dies or not, the benefit will be paid to the beneficiaries or to himself, right? The fourth one is the Myear Deferred whole life. So there is a deferment period of M years. So if death occurs anytime during the first M years after issue, nothing is paid. But if death occurs after M years after issue, at least M years after issue, the benefit will be paid to the beneficiaries. And the last one, which is the Myear Deferred N-year temporary. So you have a deferment period of M years, but there is only an N-year term. So the benefit will be paid only if death will occur at least M years and at most M plus N years after issue. Okay. Now, there is another type which is not actually an insurance, which we call pure endowment, the N-year pure endowment insurance. And this is paid, the benefit is paid at the end of N years if the insured survives to that time. Okay? So there is an N-year contract again, but the payment will be paid on the contingent, the payment is paid on the requirement that the insured must be alive and it will be paid at the end of n years. Okay? Now, to determine the main problem now for this particular chapter is to determine what we call the net single premium. This net single premium represents the present value of the benefit that is paid sometime in the future, right? The time of the payment is not known because it is dependent on the time of death of the insured. So we need to define a random variable to represent this present value. And we will use capital Z to be that random variable. So capital Z is the net present value of the insurance. And this random variable is dependent on dependent on several things. One would be the size of the benefit. Another is that it's also dependent on the interest rate that is being applied. And also, and more importantly, the date of death of the insured, because that will tell us the time when the benefit is going to be paid. Okay? So, for each type of insurance, we need to define the corresponding random variable Z. And what we want is actually the expectation of this random variable Z. And that expectation, as what I said earlier, is called the net single premium for that particular insurance. Okay? So let's begin with the first type, which is an insurance policy that is payable at the moment of death. Okay? So the time of payment of benefit of the insurance is dependent on the length of time between issue age and at the death of a person aged X. So here we're assuming that the policy becomes the policy is bought, or the policy remains in force at the issue age of the insured, which is age X, and we are interested in finding the size of the benefit of the present value of the benefit which is due at the time of death of a certain person aged X. And we have defined a random variable to denote that time of death, right? That random variable t that we defined in the previous chapter, which is the future random variable, the future lifetime random variable of a person aged X. So our random variable Z is going to be dependent on this random variable T if our insurance is payable at the moment of death. Actually, our random variable Z uh, is going to be defined as the product of two functions which are both functions dependent on t. These are one, the benefit function, p sub t. Okay, so b sub t will be the size of the benefit at time t, and v sub t, which is your discount factor. So since b sub t is due at time t, you need to discount this for t periods of time to determine its present value. Okay? So in other words, z now is equal to b sub t times v sub t. So it's the size of the benefit at time t times the corresponding discount factor. Okay? For time t. So here is an illustration. Actually, this is the first type of insurance, the whole life insurance with benefit of 1 unit. So the assumption is that the insurance is payable at the moment of death, okay, and that the size of the benefit is 1 unit, and this will be paid immediately after the time of death of the insured. Okay, so given this, the size of the benefit at time t, at any time t, is 1 unit, right? And the discount factor would be v to the t at any time t. Okay, this otherwise would be for values of t that is less than 0. Anyway, our t is always greater than 0. So v sub t is v to the t for any t that is greater than or equal to 0. So the corresponding present value random variable for a whole life insurance with benefit of 1 unit and payable at the moment of death is b sub t times v sub t. So that is 1 times b to the t is v to the t, and that would be the value of z whenever t is greater than or equal to 0. Okay? So to get the expectation of z, that would be v to the t times the PDF of the random variable t, which we said is tpx mu sub x of t times dt, where t ranges from, since t is greater than or equal to 0, will range from 0 to infinity. Okay? So this integral gives us the net single premium for this particular insurance. And that net single premium is given this representation. Okay? So this is our notation for the net single premium of a whole life insurance issued to a person aged X, payable at the moment of death, and the benefit is 1 unit. Okay? So the subscript X tells us that it is a whole life insurance issued to a person aged X. Capital A will tell us that this is a net single premium of a life insurance product, and with a bar on top of capital A will tell us that this is an insurance where the benefit is payable at the moment of death. Okay? And then we also need to figure out the variance of our random variable z. So we first get the second moment of our random variable z. So the expectation of z squared would be v to the t squared, quantity squared, times the PDF of t dt from 0 to infinity. But we know that v to the t is equal to e to the negative delta. So v to the 2t is the same as e to the negative 2 delta t times tpx, and which we can rewrite this way. Okay? So this is actually in the same form for the expectation of z, except that the interest rate, the force of interest, which is now originally delta for the expectation of z, is replaced by 2 delta. Right? So, in other words, this shows that the expectation of z squared at delta sub t is equal to the expectation of z at 2 times delta sub t. In this case, delta sub t is delta t, right? Delta t. So, yeah, delta t. So what we're saying now is actually we can generalize this. The jth moment of the distribution of z can be found by doing the following, right? And that gives us this. So this is the expectation of z evaluated at delta sub t times j, right? So the expectation of z to the j at delta sub t is equal to the expectation of z evaluated at j times delta sub t. Okay? Now, this rule is what we call the rule of moments, which actually holds whenever the insurance is of unit amount and the force of interest, the delta sub t, is deterministic. We will use for this particular whole life insurance the second moment of z by this notation. Okay, so this is the actuarial present value of a whole life insurance of a unit amount calculated at 2 delta, right? Because, yeah, that's what it would now represent. And so the variance is the second moment minus the square of the first moment of z. Okay, so this gives us an expression for the variance of z, where z is the present value random variable for a whole life insurance of 1 unit. Okay, for the Myear term insurance with a benefit of 1, so the benefit would be 1 if death occurs within n years, right? So whenever t is less than or equal to n, that means the person aged X dies within the n-year term, the benefit would be 1 unit. And if t is greater than n, that means the insured survives to n years, so the benefit is 0. So there's nothing is paid. So this is the corresponding discount factor since death occurs here at time t, sometime between 0 to n, the discount factor will be v to the t. And here there's no discount factor because nothing is paid. Okay? And so z is 1 times v to the t if t is less than or equal to n, and 0 otherwise. So the expectation of z now is v to the t times the PDF of t times dt from 0 to n, right? So this is now the net single premium of an n-year term insurance with benefit of 1 unit issued to a person aged X and payable at the moment of death. So that will be represented by this notation. Okay? Take note that there is a 1 on top of X. So that means between the statuses X and N term and N, the status 1 will die first. That means the person age X dies before the N-year term elapses. Okay? So under the rule of moments, the variance of Z now takes this form, where this is the second moment of Z. So in order to do that, we just have to replace v to the t by v to the 2t. Or e to the negative delta t, we replace it by e to the negative 2 delta t. Okay? 4. And then let's talk about the n-year pure endowment of 1 unit. We said that for the n-year pure endowment, a benefit is paid if the insured survives after n years, right? So if t is greater than or equal to n, that means the insured survives for n years, a benefit of 1 is paid, right? A benefit of 1 is paid if t is greater than or equal to n. And nothing is paid otherwise. Okay? So the discount factor will be v to the n, exactly n. This is n because the payment is paid at time n. That's fixed, right? So the discount factor will be v to the n. So our random variable z is v to the n if t is greater than or equal to n is 0 otherwise. So the net single premium now, the expectation of z takes this form. So it's v to the n times tpx mu sub x of t times dt, where the integral where t ranges from n to infinity. And then v to the n is a constant with respect to t, so we can factor that out. And this is the PDF of t. We're evaluating the integral over the PDF of t over possible values of t, which is from n to infinity. So in other words, this integral is the complement of the CDF of the random variable t evaluated at n. And assuming that capital G is the CDF, so the integral is actually 1 minus the CDF of t evaluated at n. And we know that the CDF of t evaluated at n is actually nqx, right? So 1 minus that is npx. So the net single premium for this n-year pure endowment insurance is v to the n times npx. And this would be the representation, right? I'll take note that this time there is a 1 on top of n, the term n, because between the statuses x and the n term should fail first, right? So it should be that the n term elapses first before the death of this person aged X. Notice that there is no bar on top of A because this is not payable at the moment of death. It is payable at the end of n years, whenever it is paid, whenever it is needed to be paid. Okay? Now, for the n-year endowment, the expectation of Z can also be derived in the following way. We know that the size of the payment is known. We know the time of payment is also known at the end of n years. What is uncertain is whether or not a claim will occur. Okay? So in other words, we can define a random variable y that can take two possible values, which are either 1 or 0. So it takes 1 if a claim will occur, That is when the person age X survives to age X plus N, and 0 otherwise. So when no claim is going to be, uh, where no claim is going to occur. And so the random variable Z is just the present value of Y, which is in this case V to the N times Y, right? V to the N times Y. So if this Y is going to be paid, its present value is Y times the discount factor. Okay? So the expectation of Z is the expectation of V to the N times Y, and V to the N is a constant. So this is V to the N times the expectation of Y. But Y is Bernoulli, right? With the parameter P, the probability of success is the probability associated with the event that Y is equal to 1. In this case, it would be the probability that the person HX survives to HX plus N. And we know that that is NPX. So the expectation of Y is NPX. So this net single premium is V to the N times NPX as was obtained earlier. Okay? And using this form, we can get the variance, right? So the variance of Z is the variance of V to the N Y. So that is the square of V to the N times the variance of Y. But the variance of Y, again, Y being Bernoulli, is P times Q, right? The probability of success P times the probability of failure Q. The probability of success we said is NPX, and so the probability of failure is NQX. So the variance is V raised to 2N times NPX times NQX. But then NQX is actually 1 minus NPX. So then we arrive at this form, right? Okay? This would be V to the 2N times NPX minus the square of V to the N times NPX. Okay? And then we have the N-year endowment insurance. We said that this insurance will provide a benefit of 1 if death occurs within N years, and it will be paid upon the death of that insured or a benefit will be paid at the end of N years if the insured is alive at the end of N years. So which means regardless of the time of death, the benefit of 1 will be paid during that time. Okay? However, we take note of the following. We need to incorporate now the discount factor. If death occurs within N years, the benefit of 1 will be paid at time t, right? So the discount factor would be V to the t. But if death is after N years, so at the end of N years that individual is still alive, the benefit will be paid at time N. So the discount factor should be V to the N. So in other words, our Z is defined in the following way. So it takes V to the t if t is greater than or equal to n, and it takes v to the n if t is greater than n. So the expectation of z is the sum of these two integrals. The first integral corresponds to the event that t is less than or equal to n. So it's v to the t times the PDF of x times dt, where x ranges from 0 to n. The second integral refers to the event that t is greater than n. The value of z is v to the n times the PDF of t times dt, where t ranges now from n to infinity. Okay? And if you refer this to the previous slides, this is actually the net single premium of an N-year term insurance. This is the net single premium of an N-year pure endowment insurance. So in other words, the net single premium of an N-year endowment insurance is the sum of the net single premiums of the N-year term and the N-year pure endowment. And this would be the representation for that net single premium. I'll take note that there are no ones already. Okay? So either of these two statuses will fail first. It doesn't matter which one fails first. Okay? Now, to get the variance, we take note of the following. Okay, we'll define it this way. Z sub 3 is the random variable, the present value random variable, the present value random variable for our N-year endowment insurance. Z sub 1 is the present value random variable for our N-year term insurance. Z sub 2 is the random variable, present value random variable for our N-year pure endowment. Okay? It is clear that Z sub 3 is Z sub 1 plus Z sub 2, right? So this V to the T is actually V to the T plus 0 whenever T is less than or equal to N. And then 0 plus V to the N is V to the N whenever T is greater than N. So we can see that Z sub 3 is Z sub 1 plus Z sub 2. And also, Z sub 1 times Z sub 2 is always equal to 0 for all T, right? So whenever T is less than or equal to N, Z sub 1 is V to the T, Z sub 2 is 0, so their product is 0. For T greater than N, C sub 1 is 0, C sub 2 is V to the N, so their product is 0. So for all T, the product of Z sub 1 with Z sub 2 is always 0. So their expectation, right, the expectation of Z sub 1 times Z sub 2 is always 0. And actually, that tells us the following, that when you now get the covariance of Z sub 1 and Z sub 2 as defined earlier, this is, we know, to be the expectation of Z sub 1 times Z sub 2 minus the expectation of Z sub 1 times the expectation of Z sub 2. But then, we know that this is 0. So that tells us that the covariance of Z sub 1 covariance of Z sub 1 and Z sub 2 is negative of the expectation of Z sub 1 times the expectation of Z sub 2. Okay? Which tells us that if we want to get the variance of Z sub 3, wherein Z sub 3 is Z sub 1 plus Z sub 2, that will require us to evaluate this. Right? But then we know that the covariance of C sub 1 and C sub 2 is negative of the expectation of C sub 1 times the expectation of C sub 2. We get to this second line. And then we know that this is the variance of C sub 1, where C sub 1 is the present value random variable for the N-year term. And this is what the variance is from our earlier computations. This is the variance of Z sub 2, and Z sub 2 is for the pure endowment, and this is its variance from the earlier computation. And we know that this is the net single premium of the N-year term, and this is the expectation, the net single premium of the N-year endowment. Okay? So we just copy this, we just copy that part, and then we combine the remaining three negative terms with the negative sign factored out. And if you look at this group of terms, it can be expressed as a square of this binomial, wherein this is the net single premium for the N-year term, and this is the net single premium for the N-year pure endowment. And then we said that that sum is actually the net single premium for the N-year endowment insurance. Okay? So the variance of the the variance of the present value random variable for the N-year endowment insurance is the second moment, right, of the present value random variable for the N-year term plus the second moment of the present value random variable for the N-year pure endowment minus the square of the net single premium for the N-year endowment insurance. Okay? Now, the last one that we'll discuss is the Myear Deferred Whole Life Insurance with benefit of 1. So we said that for this type of insurance, there is a deferment period of M years. So if death occurs during the first M years, nothing is paid. But if death occurs after the first M years, then it will be paid when that death occurs. Okay? So the benefit is 0 if t is less than or equal to m, right? And would be 1 if t is greater than or equal to m. And the discount factor, of course, would be 0 if the time is less than or equal to m. So this would mean that death occurs within m years, so nothing is paid. And when t is greater than m, so death will occur sometime after m years, and it will be paid at time t. Whenever that time t is going to occur, then the discount factor is b to the t. So the corresponding present value random variable for the Myear Deferred whole life insurance is this random variable. So it takes 0 whenever t is less than or equal to m, and it takes b to the t if t is greater than m. And so the net single premium now to get the expectation of z is the integral of b to the t times the PDF of t dt, where t ranges from m to infinity. Okay? And this is our representation for this net single premium. The M bar will tell us that it is a deferred insurance and the deferment period is M. This X would mean that it's actually whole life. Capital A again will mean that it is a life insurance net single premium. And the bar on top of capital A would mean that it's going to be payable at the moment of death. Okay? And we take note of the following, that if we go back to the net single premium of the whole life insurance, we say that it's equal to this integral. We can break this up into two integrals wherein the limits are from 0 to m and then from m to infinity, and that this is the net single premium for the Myear term insurance, and this is from the previous slide the net single premium of an Myear deferred whole life insurance. So the net single premium for a whole life insurance is equal to the sum of the net single premiums of an Myear term insurance with that of an Myear deferred whole life insurance. All of them payable at the moment of death. Okay? I think I will stop there. The lecture now is quite long. We'll continue with the examples in the next lecture, the next video lecture. Okay?